Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to discuss Kevin O'Leary, the famous Shark Tank investor, an entrepreneur, and a well-respected individual in the financial world. And he has recently just come out and gave his opinion that the growth for tech companies is only in the third inning. And if you're unaware, that's a reference to a baseball game that has 9 innings in total. So he believes we're only a third of the way there for the potential growth of the big name tech companies. And in a recent interview with CNBC, he gave his opinion on the overall volatility of the market as of late and the recent dip in some of the fastest growing tech companies of 2020. So I'm going to play a short clip describing Kevin's opinion, and let's hear what he has to say.
Obviously, tech sector really took it on the chin, but the thing that really matters is earnings and growth. And so, I look at the earnings numbers and they're just blowing them out of the water. We're having a spectacular comeback here. The economy's on fire. I think we're getting growth in the back end of this year like we haven't seen since the 50s. And so, I have to look at this as a buying opportunity, particularly in tech, where I look at the quarter over quarter growth in some of these names like Zoom that got slaughtered and say to myself, wait a second, nothing's changed. They're still growing like crazy. And all of those companies that, people said, oh, the PE is too high, their growth hasn't slowed. The earnings are terrific. I think this is just a buying opportunity, and I think we're going to keep moving forward.
So you just heard it from Kevin himself. He believes we're going to keep moving forward, and the recent volatility in the tech sector has created a great buying opportunity. So in this video, we're going to take a look at 3 companies who do have higher PEs that operate in the tech sector that are part of Kevin O'Leary's portfolio that he has been adding to as of late during the recent volatility. But before we do that, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos, and of course in this episode, we're going to focus on Kevin O'Leary and his opinion on the market that the tech sector right now is at a nice buying opportunity, especially the names that ran up very hard in 2020 and have seen a major pullback of over 30, 40, or 50% back down to a much more attractive level. And if you're unaware, Mr. Wonderful himself, or Kevin O'Leary, is actually the chairman of OShares ETFs. So it's an investment company that has 4 different products on the market, ticker OGIG, which is OShares Global Internet Giants ETF, which is invested in some of the companies we're going to discuss today, and this makes up a significant portion of Kevin O'Leary's personal investment portfolio. And if we jump into that first stock in this episode, it is ticker SHOP, which is Shopify. The company currently trades for $1,047 per share, and over the trailing 12 months, they are up by 46%. And don't be scared of the high share price. With fractional trading, you can buy into this company for as little as $1. And currently they have a market cap at $134 billion, but are on a major pullback from their 52-week high of $1,474 per share. So from that high point, the company has now fallen by close to 29%, and this is one of the names that Kevin believes will still continue to grow long term. They come with a higher PE, but the expected growth is not slowing down anytime soon. And like he mentioned, the earnings are still coming in very high. And if we take a look at their Q1 2021 results, they absolutely crushed analyst expectations. And revenue in the quarter came in at $988 million, which grew 110% over the prior year. 110% annual year-over-year growth is absolutely amazing. And with e-commerce becoming a more prominent way of our lives, I don't see the growth slowing down over the next few years. And the company beat on earnings per share as well, coming in with $2.01. And if we jump into the company's investor presentation, we can see that Shopify is trusted by some of the largest companies in the world. Staples, Fashion Nova, the WWE, Gymshark, General Mills, KitchenAid, and many more use the Shopify platform for their online e-commerce stores. So if it's trusted by some leading brands in the world, you know it is a strong platform with great success. And if we take a look, they are the second largest platform in terms of their share in the US retail e-commerce sales for 2020. Amazon controls around 39%, and then Shopify-based platforms made up 8.6% of the market. That comes in above Walmart. So of course Shopify isn't the company that's actually selling the goods like Walmart is, but they're the platform behind 8.6% of the US e-commerce sales over the past year, which is extremely impressive. And because Shopify allows any type of company to create their own store, I think that number will only grow going forward. And we can see that as the company's been expanding, they have done a great job of getting more and more customers to try out Shopify's very own personalized services and products to help drive up the company's total top line. And we can see Shopify payments have grown by 135% year over year, and Shopify Capital grew 90% annually as well. So very strong numbers from this fast expanding business. And if we take a look at the total revenue, it has absolutely exploded over the past 5 years. From only $389 million of total revenue back in 2016, that has grown by a huge rate every single year when they actually picked it up, growing by 86% in 2020 to just under $3 billion in total revenue. And year over year, like we saw for this past quarter, total sales grew 110%. And what's impressive is this is a company that has a monthly subscription fee, which is why I love this business model. And we can see their monthly recurring revenue growth accelerated in Q1 2021, and it's grown at a CAGR of 45%. So every single month, their monthly revenue generating just from the consistent subscriptions is now at around 90 million and is growing by 45% per year. And similar to Mr. Wonderful, I'm an investor who loves cash flow. I like companies who show positive free cash flow every year, and they're growing that cash flow over time. Because in reality, if you bear down business and if you take it out a very simple approach, all that matters is free cash flow and a company's ability to generate cash over the long term. And we can see with Shopify that the company is pretty much going through the typical growth stages of a young tech company. They were posting negative free cash flow back in 2016 and 2017, but then over time, as they've grown, they've become profitable and actually posting some very strong free cash flow growth from 8.2 million all the way up to 382 million back in 2019. And then in the trailing 12 months, they've generated over $615 million of total free cash flow. So I love seeing this upward trend. I believe revenue and earnings will grow over the long term, and the company's cash flow ability will continue to expand as well. So I think Shopify is a very interesting company in going forward. Analysts believe it will continue to grow at over 27% per year for the next 5 years in the future. And currently, it is considered a slight buy, and the share price of $1,047 is well below the 12-month analyst expectation of $1,484 per share. So a ton of implied upside to get to this level if these analysts are correct. So Shopify is one of the companies that is in Mr. Wonderful's portfolio. He loves the brand. He has owned it for a long period of time. And after the recent dip in the market, it was one of the companies he has been recently adding to and believes the growth of this brand is nowhere near slowing down. So that was the first name we're going to discuss in this episode. And now if we take a look at company number 2, it is ticker ETSY, which is Etsy. They currently trade for $156 per share. And even after their most recent decline, they're still up 101% over the trailing 12 months. The company has a market cap right around 20 billion with a forward PE of 44.4. And if we take a look at the most recent share price performance, from their 52-week high of $244 per share back on March 1st, 2021, so only about a few months ago, they have now fallen by over 35% back down to the current level. So this is an e-commerce platform that's designed to sell personalized and unique goods. And when surveying their customers, 88% agreed that products they buy on Etsy cannot be found in traditional stores. And this stat right here is why I believe the company will be successful over the long term, and I agree with Kevin OLeary on his position on this stock. This is because once retail comes back and stores reopen, I do think going in person to shop will be a thing people do. I don't think it will ever be as large as before the pandemic, but it's still going to be back to a prominent way in our lives. And I think the fact that Etsy sells products that you can't find in stores is going to make this company more durable and reliable even after retail locations open up all across the country. And over their latest earnings, the company posted some great numbers, but the stock still fell. And they actually received an upgrade saying time to buy the stock during this dip post their Q1 earnings. And if we take a look, they have more and more active buyers every single quarter, and their repeat buyers are growing as well. So what that shows is the company's doing a great job of getting new individuals to make their first platform purchase on Etsy, and then after that, a ton of their people who have made a purchase are coming back for more. So the platform's done a terrific job of not only growing their new user base, but also retaining their existing buyers. And this retention rate is very strong, and I do believe will continue going forward. And if we take a look for Q1 2021, they had revenue of $551 million, which was up 141% year over year. So that puts into perspective, companies like Shopify and Etsy are both posting insane growth numbers over the prior year, even though investors are selling out of the company, and they're both down over 35% from their highs. And their Q1 adjusted EBITDA came in at $184 million, which gives them about a 33% margin. And if we take a look, the company has very little capital expenditures due to the nature of their business. They're a digital marketplace. It's not a very capital intensive business, which leads to some strong free cash flow overall. And if we take a look at the cash flow statement, similar to Shopify, the company's been growing their annual cash flow by a great amount. From back in around 2016, 54 million of total free cash flow, and every single year, that number continues to grow to a record high of $787 million of total free cash flow during the past 12 months. And why that's so impressive is for a young tech company that's not capital intensive, they can bring up a lot of cash, focus on research and development, innovation, pay down their small amount of debt on the balance sheet, and still operate in a very healthy financial position. And they can also reward their investors by buying back more shares as time goes on. And going forward, analysts like the company and are projecting 48% annual growth each and every year for the 5 years going forward, and they are considered a strong buy, coming in at a 1.7, and the current share price of $156 is once again very far below the 12-month expectation of 226, and like we saw, they just received an upgrade to a buy after their earnings report. So although there's different people who don't believe Etsy will succeed long term, I think the platform speaks for itself. They attract more and more new active buyers, they have strong repeat buyers, and the fact that they sell unique products that are a little bit more personalized and you won't find them in a big box store, that will kind of set them apart and allow shoppers continuing to go to Etsy even after the world fully reopens and the pandemic is over. So another big e-commerce based company that's in the tech sector that has taken a huge decline as of late, and I believe has fallen to a much more attractive valuation, sitting with a market cap at right around $20 billion. So this was the second tech company that Kevin O'Leary has his eye on right now. And if we finally move on into the third and final name that we're going to discuss today, it is ticker BABA, which is Alibaba. They currently trade for $206 per share, and over the past 12 months, they're only up by 9.8%. So if you're unaware, this is one of the leading tech companies in the Chinese economy. They're one of the strongest brands in the world, and right now, they have a market cap just below $600 billion. And after the major decline in share price, the company is trading with a forward PE right around 21.6. So this company, who has seen incredible revenue and earnings growth over the long term, is trading with a forward PE ratio just around the market average for the S&P 500. And without a doubt, many investors believe that this company and their future growth will grossly outperform the overall market. So to get into a company trading at the same valuation as a very simple index fund, but higher potential growth, I believe is very attractive. And if we take a look at the 1 year chart, their highest point came in right around $317 back in October 2020. But of course, from that time, they have been under investigation by the Chinese government, and after probably the hardest investigation ever for a big tech Chinese brand, a monopoly investigation, they were only hit with a fine of right around $3 billion. And for a company that has over $70 billion of cash on the balance sheet, it was a very minimal impact to their financial health. And we can see here from the $317, they have now fallen by 35% back down to their current level. And I believe this investor draw is way too overdone. They just shared their Q1 2021 numbers, and they did post their first operating loss for a quarter of $2.8 billion due to this fine. And although this is their first loss since 2012 in a single quarter, I think investors are overdoing this short-term hiccup. This company, if we take a look at the numbers, still saw incredible expansion. Total revenue in the quarter, this is in the quarter by the way, $28.6 billion in US dollars, growing 64% year over year. This is not a small tech company like Etsy who's expected to grow at such a fast rate because they're worth only $20 billion. This is a $600 billion company that expanded their total top line through a global pandemic by 64%, which is absolutely insane. And their platform and their mobile app has over 900 million monthly active users, which is incredible to say the least. Every person almost in China, over 900 million people, are using their app at least once a month, which is absolutely ridiculous. And this company still has so much room to continue to grow because they're so well diversified. And if you take a look at some of my recent videos, we have gone a little bit more in depth on Alibaba and the future of the company. So 64% year over year revenue growth from this big tech company is ridiculously. And going forward, Jack Ma, the leader of the business, says they expect to grow another 30% through 2021 and into 2022. So the company is already doing around $100 billion in annual revenue with a profit margin right around 25%, and that's expected to continue to grow by another 30% going forward. And if we take a look at the income statement, we can see how fast they have absolutely exploded over the past 5 years. Back in 2016, the company did total revenue of $15.6 billion. Fast forward 5 years later, in the trailing 12 months, that has grown to $98.6 billion in total revenue, and this does not factor in the most recent quarter, which they grew by 64%. So in the trailing 12 months, they've generated over $100 billion in annual revenue in US dollars, which is absolutely ridiculous. There's not many companies generating these kind of numbers. And of course, before their slight loss in the quarter, over the past 12 months, they generated over $24 billion in net income, which is absolutely fantastic. So this company has incredible growth, and they're trading with a valuation relative to the overall market. They're down 35% from their highs, and even after the big investigation has concluded, people are still staying on this company when there's still a ton of upside ahead. And if we take a look at their cash flow, this is represented in the Chinese yen. This is not US dollars, but the growth is all relative. And we can see over the long term, their total free cash flow continues to expand annually to over 164 billion in the Chinese yen. So as long as this number isn't though in US dollars, we can see the growth continuing to happen every single year. And going forward, analysts once again have some big expectations on the company with a current price target of $312 per share with a current strong buy rating on the stock right now. So as a whole, Alibaba is the third company that Kevin O'Leary does own in his OJIG portfolio. I think it's another brand that's going to dominate over the long term, and the current growth projections outweigh the expected risk in my own personal opinion. Not a recommendation, in my own personal opinion, I think Alibaba is still a strong brand to make a next addition to a diversified global tech portfolio. So those were the three companies that are part of Kevin O'Leary's OGIG portfolio. He believes in the tech sector. He thinks they're only in the third inning of their growth. And like we saw right at the beginning of the episode, he shared his opinion on CNBC, saying that this most recent volatility has created a great buying opportunity for most investors to get in to some strong growing fast tech companies who are still posting strong earnings that have not slowed down whatsoever. So thank you for watching to the end. We're going to recap the video. Just remember, I am not a financial advisor. Nothing we say on the channel is ever financial advice or recommendations. I'm just a random YouTuber describing his opinion on the market, going over different articles, and sharing his thoughts and what he sees going on in the world. So thank you for watching. Please hit that like button, subscribe, and join the community, and I will see you in tomorrow's video.